a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about bank stocks and ETFs. And these bank stocks, particularly big bank stocks, they have been shining this year. And the largest US banks, they recently reported strong third quarter results with profits and revenues exceeding expectations. And that was thanks mainly to increased revived M&A and IPO activity, steady corporate spending, and solid consumer demand as well. And these banks have benefited from a resilient economy and healthy loan portfolios. Loan delinquencies, they remain low so far, and they continue to gain from strong trading amid a rising stock market. And the sixth largest bank in the US, they earned about $41 billion, and that was up 19% year over year. That is according to the Wall Street Journal. Now, bank CEOs did express some caution about potential challenges ahead, but banks are, they are still positioned to benefit from lighter regulatory scrutiny under the new administration after a more aggressive regulatory agenda under the Biden administration. Relaxed capital rules have benefited these bank stocks. And finally, major banks are leading in AI adoption, and they are already reporting measurable cost savings and efficiency gains from AI. Now, looking at these stocks, big bank stocks, you will see that these have done quite well. So, here I have the six largest banks. Citibank is up about 59% year to date, Goldman Sachs 54%, Morgan Stanley 45%, JP Morgan 34%, Wells Fargo 31%, Bank of America 26%, and the S&P 500 index is up about 18% year to date after all these gyrations. Now, regional banks, on the other hand, they haven't done so well. And that is mainly because regional banks, they have higher exposure to commercial real estate and other pressured sectors. And in October, regional bank stocks had sold off sharply following reporting on some charge offs linked to fraud and bankruptcies of subprime auto lender Tricolor and auto parts supplier First Brands Group. And then these regional banks also, they do not have the tailwinds from trading and investment banking that have been benefiting big banks in particular this year. Now, the Fed is expected to cut rates tomorrow. We are recording this on Tuesday, and potentially a few more times next year, and that could benefit banks further, particularly if rate cuts are accompanied by a steeper yield curve. That's what we expect, and if the economy remains resilient. So, in that case, in that scenario, banks could see wider net interest margins and stronger loan demand as well. And as I mentioned, big banks are particularly well positioned. Regional banks could also benefit if this scenario materializes. Now, let's take a look at bank ETFs, popular bank ETFs that are quite different from one another. So the financial sector Spider Fund XLF, this is the most popular and one of the cheapest bank ETFs. It has 54 billion in assets and 8 basis points, just 8 basis points in expense ratio. And as the name suggests, it holds S&P 500 financial stocks. If you want to learn more about this ETF, you can go to the quote page on zacks.com. You can read our research report articles using the link. You can go to State Street webpage for this ETF and see what it does. Now, looking at the holdings, you will see that Berkshire is its top holding. About 12% weight is assigned to Berkshire, and we should note that Berkshire has underperformed the S&P 500 index and other big banks this year. Berkshire stock is up just about 9% year to date, and particularly after Warren Buffett announced his retirement, this stock has been under pressure, and other macro headwinds also have been impacting this stock. And so that is the reason why XLF has slightly underperformed the other big bank ETF that we will talk about. And in XLF, then you see other top holdings include JP Morgan, Visa, MasterCard, Bank of America, and Wells Fargo. Now, the second ETF that I'm highlighting, it's Invesco KBW Bank ETF. That is ticker symbol is KBWB. And in full disclosure, I own it in the ETF investor portfolio that I manage. This holds money center banks, regional banks, and thrift institutions, but more weightage to bigger banks. A modified market cap weighting has a concentrated portfolio of about 25 holdings. This is also quite popular, 5.9 billion in assets. Pricier with comparatively pricier 35 basis points expense ratio. Again, let's go to the quote page on Zacks.com, and using the link, we'll go to Invesco webpage for this ETF, see what it does. As I mentioned, 26 holdings. Looking at the portfolio, it is concentrated in the big banks that we talked about: Morgan Stanley, money center banks, Morgan Stanley, Goldman Sachs, Wells Fargo, Bank of America, JP Morgan, and Citibanks. And then you will see that other smaller regional banks, etc., in the portfolio. And the third ETF that I'm highlighting focuses on regional banks. The ticker symbol is KRE. It holds US regional banks, and this follows an equal weighting scheme, has about 140 holdings, 3.7 billion in assets, and expense ratio same as KBWB. And again, we can go to the code page on Zacks.com, and from there, State Street's web page, and we can look at the holdings. So almost equal weights. At the time of rebalancing, they will be brought to equal weights. Like Cadence, Valley National Bank, Columbia, Citizens Trust, etc., are its holdings. Then on the next slide, I have the comparative performance of these ETFs versus the S&P 500 index. KBWB has the best performance. It is up about 28%. Then the broader financials ETF XLF, the most popular one, where we saw Berkshire is the top holding, that is up about 12%. And the regional bank ETF, which has underperformed, as I mentioned and discussed the reasons earlier, that is up about 10% year to date. Thanks for watching. Make sure to check out Saks.com/promo for an interesting offer. Make sure to subscribe so that you do not miss any of our videos. And I will see you next week.